How many of you invested in Bitcoin or another crypto asset before 2015? All right, so you guys don't really matter for this speech. But the rest of you, this is for you. I decided to do something new, not talking about Augur. Got plenty of speeches about that online. Instead, I'm going to talk about the evolution of crypto asset investing. So this is something that we don't really talk about, the context behind this new asset class that's got people so excited. And so let's start. In the beginning, there was one coin, not the scam, but like Bitcoin. Satoshi Nakamoto, pseudonymous creator, invented a new paradigm for exchanging value between individuals on the internet. Previously, value had been siloed by historical institutions such as banks and governments. And now, for the first time, there was a digital gold, and potentially more. At first, this just appealed to libertarians, cypherpunks, anarchists, weirdos, if you will. But those guys became very rich from investing in this. And this technology began to appeal to more. For those of you that can't read what it says at the top, it says, and then there were millionaires. And all of a sudden, this technology became a lot more interesting to academics, economists, scammers, and entrepreneurs. And this spawned the first epoch of the Wild West of crypto assets. I'd say we're in the second Wild West today. And from 2011 to 2014, young Bitcoin enthusiasts, or older ones, who had created wealth and fortune for themselves started to build business around this technology. Payment processors, wallets, exchanges, the sorts of businesses that you create when it comes to currency. And most of these guys weren't very good entrepreneurs. Most of these businesses failed. And really, the main business that we saw here was the people creating their own coins. That's where most of the wealth was created in the early days. You create a coin, you convince people to go mine it, and all of a sudden, overnight, you become a millionaire. It was a pretty cool business model. The second business model that really worked in the early days of Bitcoin was thievery. So this is climb of the crypto crooks. What you had were sometimes just amateur entrepreneurs that didn't know what they were doing, that weren't able to secure the Bitcoin that they were holding for customers. But if you were a Bitcoin enthusiast before 2014 and never held your money on an exchange or dark market or any other sort of service, there's a likelihood you probably lost some Bitcoin at one point. A lot of businesses failed. A lot of exit scams existed, and when Mt. Gox in early 2014, the largest exchange in the world, which accounted for over 80% of trading volume, imploded with over $500 million in Bitcoin, it marked the beginning of crypto winter. Probably not the last one we'll have, but a marked period in this industry's history. From 2014 to 2016, trading volume plummeted. The market capitalization and value of a Bitcoin dropped precipitously. And it wasn't a very fun time to be in this space. Well, some of us had fun. But it was not a good time to be in Bitcoin. Most people pronounced it dead. Most people forgot about it. Many joked that the golden age of Bitcoin was over. But something interesting happened at this time. I called it adolescence. Crypto assets went through a sort of puberty. Seasoned entrepreneurs like Jeremy Allaire of Circle, Wences Casares of Zappo, people that were very well respected in Silicon Valley, Wall Street, and beyond, began to trickle into this industry and build businesses on top of Bitcoin and the newly discovered term blockchain technology, which applied to more than just currency. In theory, as the most powerful woman in Wall Street would note, Blythe Masters, this technology allowed any sort of value to be exchanged, not just payments. And around this time, Ethereum was introduced. And they did one of the first major ICOs, which we'll get to shortly. But Ethereum introduced the notion that you could create more than just currencies with blockchain technology, but entire applications, perhaps even governments, businesses that existed entirely in the ether, if you will. And this is really important because it led to the blockchain bonanza that we have today, which is where all of a sudden the mainstream media, tech outlets, some of the earlier adopters in the rest of the world began to pay attention to the fact that there was actually a lot going on in this space. Maybe Bitcoin was not at $1,000 like it had once been, but there were a lot of people building very cool businesses for transferring money, for different forms of value exchange. And all of a sudden, you had a Bitcoin rally, and as the media picked up on what was going on, it became a self-fulfilling prophecy because Bitcoin and crypto assets are driven by sentiment. So when the media starts covering this asset class, the price goes up. And so all of a sudden, Bitcoin was not worth just $500, $600 as it had remained stagnant for the past couple of years. All of a sudden, it was worth thousands of dollars. And that sort of interest precipitates into a growth of an asset class. And so what you have driving this, partly, is the phenomenon of an ICO. ICOs are incredibly interesting because they are one of the most promising and also frightening areas of blockchain investing. They represent a paradigm shift in how capital formation occurs. While crowdfunding has existed in the past, it has not existed nearly to the extent that ICOs have brought to life in the past 2 years. All of a sudden, an entrepreneur from anywhere in the world, not just Silicon Valley, can have a great idea, and instead of relying on a few old white dudes on Sand Hill Road or in the financial capitals around the world and go and beg them for money, all of a sudden an entrepreneur can go and just tell the world about their idea and potentially raise the capital they need to realize it. And so Mastercoin was the first ICO in 2013. MadeSafe came along shortly after. Then there was Ethereum with Augur, which I co-founded. We did the first ICO on top of Ethereum. And all of a sudden, we proved to the world that with Ethereum, it was so much easier to create a new blockchain project because Ethereum enables token creation through a protocol known as ERC20. And all of a sudden, anyone in the world can really just make a token and potentially capitalize on their great idea that they've probably outlined in a white paper. Now, unfortunately, most of the ideas we see today are absolute garbage. And this is why this is a really dangerous asset class to invest in, because most ICOs will never be realized and they're probably going to fall flat on their face. But it's a very exciting time because all of a sudden we are not constrained by the traditional restrictions that finance has imposed upon us. All of a sudden, if you have a very capital-intensive project that needs money right away, you can actually do it without being a large corporation. This is incredibly exciting. And with the massive appreciation in some of these tokens, you know, Ethereum raised $18 million, it's worth billions of dollars today. Quantum raised $15.5 million, it's worth $1 billion today. You have the rise of the crypto hedge fund. My good friend Olaf Carlson-Wee started one about a year ago. He realized ungodly returns, and now everybody wants to replicate his success. You have hedge funds popping up left and right, over 80 applications to the SEC just in the past 6 months. And all of a sudden, traditional investors have a vehicle for getting exposure to this asset class, which is a fantastic thing because it allows this asset class to grow much faster. However, I will make a point and say that I'll make the same bet that Warren Buffett did 10 years ago with any hedge fund manager that would take him up, and say that due to the democratized nature of crypto asset investing, the best hedge fund managers are not going to be traditional funds. They're going to be individuals using platforms like Shapeshift's Prism, which allow you to create your own digital asset portfolio and are just going to be able to share their performance with the world and are going to blow any traditional fund out of the water because, there's a guy in his basement that's figured out how to play the market better than anyone else. This is a democratizing technology. It sometimes feels with all this institutional capital coming into this space that, it's becoming more traditional. It's not. Anybody can buy Bitcoin. Anybody can buy crypto. And that's not going to change. Well, if you're in China, I'm sorry. But those guys are going to figure it out too. And so at the end of the day, even as this technology becomes more institutionalized and investing in this space becomes so as well, the average consumer still has unbridled access to technological innovation and in investing at a much earlier stage than they have ever been able to pretty much in human history. And so what you have to ask yourself is, what do you want to invest in? This is what I call the opportunity matrix. I made this yesterday, and it's kind of a chart from lower reward, lower risk to high risk, high reward. And you have to remember that this space actually has a lot of different investing opportunities. At the top right, it's the ICOs that you hear about every day. If you're not careful, you're probably going to get burned. Even if you are careful, you're probably going to get burned. Good to remember that. Then you have tokens, which are pretty high risk. Application tokens often have done ICOs in the past, but exist today and enable applications to work. If you're a firm believer in the application, you're going to see a huge upside from that application being adopted. But the likelihood of a decentralized application actually being adopted is incredibly low. So that is something you have to consider. Right below application tokens or utility tokens are protocol tokens, the tokens that secure blockchains, such as Bitcoin, Ether, Quantum. These tokens are a much better bet than application tokens because all that you need is validators or miners in the network to maintain its value, as opposed to actual consumer adoption of the technology, at least in the short to medium term. Then, to the left, lower risk, lower reward are the hedge funds. You get an aggregate of all the different investments that you can make in this space. Those are sometimes a good idea, but if you're a non-accredited investor, or maybe not in the US, it can be quite hard to invest in hedge funds. So platforms like Shapeshift's Prism become suddenly interesting. Unfortunately, with platforms like that, you can see other people's trading history. One disclaimer, never trade more than you can afford to lose, unless you're young, and then it's okay. And then lastly, there's an ICO fund, which is just high risk, low reward. Wouldn't recommend it unless you just think the person investing is a total genius. Like, if you want to give me your money, all right, I won't blame you. Lastly, there's security tokens. We haven't actually seen these flourish yet. Blockchain Capital, my venture fund, did the first security token ever. The token represents a limited partner interest in our fund, but security tokens are going to flourish far beyond just venture capital. They're going to exist for the real estate industry. I think the entire real estate industry is going to eventually be tokenized. I don't see why any piece of real estate really should be illiquid like it is today. I think it should be freely tradable. And anything like music royalties, artist payments, all that can be tokenized. All these can be turned into security tokens. These are actually really good bets long-term because they make illiquid investments liquid and tradable. Low risk, reward's not great, but it's a great investment that you have the sort of return you would have on a traditional investment while still having the liquidity that a blockchain provides. And so that's kind of how I view the investment opportunities that exist in the blockchain space today. I think it's a very promising, it's the most promising space to be investing in as a consumer, potentially as an institutional investor. This technology has the potential to revolutionize the world we live in, and so I couldn't be more excited about it. I've got 20 seconds, so thank you for your time, and I'll take one question. Yes?
Part owner into some asset. Do you think this will actually bring some sort of governance where with the other owners you decide something about this asset?
With a security token, I was asked if this will add a governance mechanism to these tokens, the security ones. In theory, no. This is just putting it on the blockchain, making it more liquid, portable, divisible, exchangeable. But in theory, you can add all the features that blockchains have, including governance, if you were to add that to a security token, and that would then enable the token to work in whatever way you want it to. I'm available for questions in the back. Thank you very much.